Okay, let's talk about another method quickly. It's the penny stock method, and you will see this a lot if you look online through certain financial sites. Excuse me. Um, so what in the world is a penny stock? Okay, now a penny stock is anything really under like $1.50, $2 per share. People would consider that micro cap or just very small, um, small stock, penny stock. It also can literally mean stock that are selling for pennies. Okay, so there's stock that sells for 2 pennies a share, 3 pennies a share, 10 cents a share. Um, Now, the reason this is so alluring to an average middle class person who wants to try to do this is that you actually have leverage without going into debt. See, I said at one point leverage was the ability to buy a lot of quantity of stock, okay, at once. So the question is, where do you get all that money? So if you have all that money in your account already, you're highly leveraged, but it's your own money, so you don't have much debt obligation at all. The thing is, okay, a lot of people do this with OPM, other people's money. I'm talking about mutual funds. I'm talking about hedge funds. I'm talking about uh, broker services. I'm talking about investment banks on a different level. But so they'll do it with other people's money. So really, this ton of money they have that they use to buy a ton of these stocks for quantity is money that they're obliged to pay back to someone. They're under debt obligation. So that's why the term leverage also means you're highly in debt to people. It doesn't have to mean that, but almost in many, many cases it does. It means you have a lot of money to play around with, but it's not your money. Tons of it, if not all of it, is somebody else's money. So you have the leverage to work the stocks, right? And just a little bit of gain when you have a huge amount of it is going to be a nice return for you. Other people are working the lever on you because you are under legal obligation to pay back their money. It's not your money. You have to be very careful with it. All right, that's why regulators are so heavily involved with because of the legal obligations you have when you take someone else's money. All right, to the owner of that money. So, well, the thing about penny stocks is it allows the common investor to sense this mechanism, this leveraging, this without having to go into debt with anyone else. This is what I mean. Let's say you have $1,000. You'd actually have to have like 1,010 or something, okay? But you had 1,000 that you wanted to try out to use to try this. So you went in and you found a stock that was trading for 10 cents. Somebody was willing to sell it, so the bid price was 10 cents at 10. So you went and you bought 10,000 shares, okay? You can get 10 for $1. You have 1,000, buy it all. You got 10,000 shares. And you bought it at 10 cents. Now I threw another zero in there, okay? Because once you buy in this quantity, the the hundreds and the thousands and the 10,000, these points count as far as pennies go. They actually do. So, see, here's the deal. Let's say that you hang on to these 10,000 shares of yours, and the next day they're now selling. People are willing to buy it, so the last market price was 0.105. All right, so it's halfway between 10 cents and 11 cents, halfway there, but not there yet. If you sold at that point, all right, then I'm sorry. If you bought at 10 cents, somebody was willing to sell, so that was the sell price. Okay, and if you actually bought it, then that turned into the market price because that was the last sale. Now to make this, you have to wait till someone is willing to buy it at 0.105. So that's your bid price. Now, if you sold 10,000 shares at this, you would make $50. Okay. just on that half penny. So people are thinking to themselves, well, surely the stock can go up a half penny. I mean, it's like, what stock can't go up a half penny? Well, you would be surprised, okay? Because the thing with now, of course, apparently you sell for 50, right? But really it's 44 because you have to pay. Well, it's 40. No, it's 42 because you have to pay for the two trades. You have to pay to buy it. You have to pay to sell it. Now that whole thing is called. Well, those are two trades. You see that? You pay to buy it, so you traded money for the stock, right? That's a trade. Then you have to pay to sell it. That's a separate trade. So you have to pay commission twice. If you're on the discount on the lower ends of these discount sites, it's $4 for that twice. So it's $8. You're down to $42 that you made. But that's not bad, is it? Especially if this happens in 30 minutes, which it seems like it can. However, if you would watch what happens to these penny stocks, the ones that sort of do this really are the hot stocks, okay? Or actually, we're going to call them the flash in the pan, and I'll talk about that later. But they have their heyday for like one day out of the year, and if you miss it, you're sunk. Because this can work backward, can't it? Now for penny stocks, it's much easier for a penny stock to fall than it is for it to rise. It's much easier for it to fall than for it to rise. So if you miss your window here, and if you think to yourself, man, it went up half a penny, I'm just going to wait till it goes up one full penny, then I'll make $100. What if it goes up 2 pennies? That's $200. What if it goes up 10 cents? It doubles in price. And you start thinking like that, and you might be unwilling to sell because you're not sure if what you're trying to do is you're trying to guess, just how high it's going to go, and you think, I want to sell at the very top. Instead of selling right here, you say, well, I'm going to wait a little bit more and I'll sell, and then so finally it does get up right now. Well, I'm going to wait a little bit more and I'll, so you're always hoping for it to grow a little bit more, but what you're not willing to do is like you bought it right here, and you're not willing to sell it right there. When you actually see it rising, you're not willing to sell it because you're like, is it done? Is it done growing? I might lose. Think of what I might lose if I sell it right now. But that sort of thing is its own problem in itself, and it applies to every sort of trade. And it's the unwillingness to capture the money, to see it and to make it, because you keep on envisioning it's going to get bigger and bigger and bigger. And what happens if all of a sudden you turn your back for 20 minutes and then and you bought it right here, and now it's right here, and it's going to be here for another year. Okay, so what I'm saying is, this little bump that people are so into with penny stocks, it works both ways. Sure, it can get you $50 up here if it goes up half a penny, but if it falls 2 pennies, it's going to cost you $200, and it's a lot easier for these penny stocks to fall than to rise. And here's the reason why. Now you think for yourself, why would any company sell a stock worth 10 cents? See, what happens is almost always companies start out private, and they grow and they grow and they grow, and they show profitable returns. So people get interested in this. It seems to be a very good company, a growing company, and then they decide we're going to go public on this. Okay, and they work with an investment bank to underwrite the initial public offering, which is what the IPO is called, IPO, initial public offering. And what happens is the underwriting bank publicizes this, and they also set the initial price of the stock. They say, we looked at this company, we looked at its potential, we looked at its management, we looked at its revenue, we looked at its costs, we looked at its debt, we looked at everything. And we think that these stocks are worth $10, $12, $15, $20, $80, $70, $30, what? How much are they worth? I guarantee you they're not going to say your stock is worth 10 cents, so let's get going. Let's do an IPO. Because these banks that do this, they charge a huge fee. I'm talking about in the millions just to underwrite a company, to get the company into an initial public offering, to turn a private company into a public company. So the bank has to ensure that at least they'll get paid, And if they want to charge $50 million to turn this, to underwrite this, and then they say their stock is worth 10 cents, no one's going to really want to buy that stock right off the bat, okay? And then the underwriting bank doesn't get paid. So the bank is always going to say the stock is worth more than what it thinks the amount of stocks that are going to be sold are going to get in relation to their own fee. So it's a little bit of a crass outlook there, but you just don't have a company going into initial public offering and saying their stocks are 10 cents. So the question is, how do you get to the point where your stock is worth 10 cents? You know how you get it? This is how you get it. It's called the long tail, okay? Here's your IP. Here it is. Here's your IPO. Maybe it starts off right here, let's say 20 bucks. Maybe it goes up, maybe it does like Facebook. Okay, Facebook went down and then it started climbing up again. Okay, that's all normal. In fact, it's very normal from the IPO for it to go down a little bit, because really what it's the market. It's the market that's going to determine how much the thing is worth. The stock is worth. Because remember, stock is perception, and it's only a lot of it's based on what the value the market perceives it to have, and the only value a stock has. Now, the only value a stock has is the number at which someone is willing to pay for it on the market. Now, I'm not talking about office machines or that sort of stuff, or the product itself, or the building. I'm talking about the stock. The only value it has is what someone is willing to pay for it. So, the bank might start it here, and you might get a couple people buying here, but the market's going to eventually determine where it is, and then it grows, and then it. But what I'm saying is, when your stock gets down to 10 cents, this is what had happened. You like went up, and then push, and then you got this long tail going out here, and this is like 1 year, 2 year, 3 year, 4 year, 5 year, and just like it's going on and on and on. The long tail. Why the long tail? Because the company is basically dead. The company is dead. Now there are some good companies that now you actually can see some of these in the .com bubble where they went down, right? They went down, and you also see this in the real estate, okay, crash of 2008. They went way down, but then somehow they started coming back up. They merged. They got they raised capital again. They did something. They fired the whole management team. Somehow they got okay. So they didn't stay down. So it's very often a company is going to have a low point. By definition, I guess every company that has a graph is going to have a low point. But how fast and when you see a company hit the low point and then sit it out with a long tail, you got problems. You don't want to mess around with that. But these are the penny stocks. Almost always these are the penny stocks. So people are willing to run around and risk themselves in here, and this company is not going to grow. And if it's like this for 2 or 3 years, people are looking at this and say, I'm not investing in that. They haven't done anything in 3 years to change their situation. This long tail is just getting short. It's getting closer to zero all along, little by little. That's not a company that's promising growth or anything. Okay, so no, it's just. In fact, the only thing these stocks are basically good for are these sorts of people that want to play around with the penny stock stuff. And so what you get, I'll talk about this in number 5. You get little bumps along the round, and if you're trying to cash in on those little bumps, it's very, very tricky, because if you miss the window, you are stuck on that long tail, and you'll be lucky to pull back what you put in. More likely than not, you're going to lose 100, 200, 300 bucks. And if you do a combination of this and you get into a penny stock because it's having a hot day, the media is into it for some reason, it bumps quite a bit. So you all of a sudden, it might bump up to 12 or 13 cents, and you buy it right then, thinking, oh, it's going to go to 15, and I'll sell it. I'll get 2 cents for every one of these shares. I got 10,000 shares, whatnot, and then it crashes and goes back to 10, 9, or 8 cents because the hot flash is over. We'll talk about this in the next one, okay? But or this thing in the next one. You can really just go through your capital really quickly. And see, what's pushing this is this whole idea that you can buy a ton of them for not that much money. But so the leveraging, thinking, hey, I'm gonna get a lot of money when it goes up a little bit because I got 10,000 shares. It people forget that it works the opposite way too. If it starts going down, you're gonna lose a lot of money. So it's definitely, I think the penny stock phenomenon is interesting because more than anything, it reveals the psychology of the amateur stock trader. All right, because of its allure, and it allows the amateur stock trader or the middle class, low income or middle income person to have the power that a much larger bank is going to have. But let me ask you this: how come the larger banks aren't doing penny stocks? They could do this all day long. But why do they ask people for their money? Give us money, so we can have it big, so we can go buy the blue chip. They don't care about penny stocks because they know that these are basically dead companies. All right, so they want stocks that have actually life to them. 10, 15, 20, 30, 40, $50 a share. So that's telling you that the market is esteeming and desiring that stock. Nobody's desiring this stock if it's been 10 cents for 3 years. So the broker houses and whatnot, they have to get this ton of cash because they want to go and do a huge amount of buying from good stocks that the market seems to value, not from this stuff. See, if this were an actual legitimate, viable, I mean, it is a strategy, but if it were a working strategy, you'd have plenty of banks. They're like, I don't need to borrow $100 million from X, Y, or Z. I'll just go buy some of these 10-cent stocks. See, they don't do it because they know this doesn't work. These stocks are not esteemed. Well, I'll let you think about that.